Welcome to the deep dive. Okay, so today we're digging into this buzz around the One Big Beautiful Bill Act of 2025.
Right, OBBBA. It's been getting a lot of attention.
Yeah, exactly.
Yeah.
You've probably heard talk about, big tax relief for workers.
Mm-hmm. Specifically tips and overtime?
That's it. New temporary federal income tax deductions. One for qualified tips, one for qualified overtime. But what does that really mean for your paycheck? That's our mission today.
Because the headlines don't always tell the full story.
Not even close sometimes.
Yeah.
We want to unpack the details, the surprising bits from the legislation. Okay, let's unpack this.
What's fascinating here, I think, is how specific the actual rules are, compared to the broad promises. Those nuances are crucial.
Absolutely. So let's get into the mechanics. First up, these are above-the-line deductions.
Okay, and why does that matter to you listening?
Well, it means they reduce your adjusted gross income, your AGI, directly, right off the top.
Before you even think about standard versus itemized.
Exactly. So basically, anyone who qualifies can potentially benefit. But, and this is a big but, they're temporary.
Very temporary. We're only talking tax years 2025, 26, 27, and 28.
And then, poof, gone.
Yeah.
Unless Congress acts again.
Right. And this leads us to maybe the biggest point people miss.
Go on.
These deductions, they only reduce your federal income tax.
Oh.
So all that talk about no tax on tips or no tax on overtime, it's misleading. Because your Social Security and Medicare taxes, FICA, they still apply to the full amount. Your tips, your overtime, no deduction there.
Okay, that is vital. FICA is still fully in play. Good clarification. So let's zero in on the tip deduction then, keeping that in mind.
All right, first, there's a cap. You can deduct up to $25,000 in qualified tips per year.
And qualified is key. Who actually qualifies?
It's limited. We're talking cash tips received by people in jobs that traditionally and customarily got tips before the end of 2024.
So like servers, bartenders.
Probably. But the Treasury actually has to publish a definitive list, so we need to wait for that official guidance.
Okay. And who's up?
Well, specifically mention are tips earned in specified service trades or businesses. Think health, law, accounting, consulting. Those are excluded.
Got it. And there's an income limit too, right?
Yes, absolutely. This isn't for the highest earners. It starts phasing out if your modified AGI, that's MAGI, goes over $150,000 for single filers.
Or double that for married couples filing jointly.
Exactly. $300,000 for joint filers. And it's a gradual phase out. For every, say, $10 your income is over that limit, you lose $1 of the potential deduction.
Okay, so it shrinks. Now, what about the overtime deduction? How does that work?
Similar idea, but different numbers, and one really key distinction. The caps are lower for singles, $12,500.
But the same for married filing jointly, $25,000.
Correct. $25,000 joint cap. But here's the big thing. The deduction only applies to the premium portion of your overtime pay.
Explain that. Premium portion.
Okay, so say your regular rate is $20 an hour. Your overtime rate, time and a half, is $30 an hour.
Right.
You can only deduct the extra $10 per hour you earn during overtime, not the full $30.
I see. Only the overtime premium itself, not the base pay earned during those hours.
Precisely. And this is for hourly workers, naturally. And it has the same income phase-outs as the tip deduction.
$150 K single, $300 K joint MBGI, and married people have to file jointly for this one.
Yes, must file jointly.
Oh, okay. Here's where it gets really interesting. Who actually benefits the most here?
Well, based on the numbers, the biggest dollar savings seem to go to sort of middle to upper middle income folks. People in, say, the 22% or 24% federal tax bracket.
But below those phase-out thresholds.
Exactly. So like a single person making $80,000, maybe they have $10,000 in deductible overtime premium. They could save around $2,200 in federal income tax.
That's significant.
It is. But this raises an important question. What about lower income workers?
Right. If you're already paying very little or maybe zero federal income tax because of the standard deduction, or maybe the earned income tax credit.
Then these deductions, well, they don't really do anything for you financially speaking. Your federal tax bill was likely zero anyway, no direct benefit there.
Okay, another crucial detail, the timing. Especially for 2025, there's a potential refund surprise.
Yes, this is a big heads up. The law starts January 1st, 2025. But the IRS won't adjust the income tax withholding tables for these deductions until after December 31st, 2025.
Whoa, so what does that mean for your actual paychecks during 2025?
It means you won't see the savings week to week. Your take-home pay won't increase immediately because of these deductions.
So the entire benefit for the 2025 tax year.
You'll only get it back when you file your tax return in early 2026. It'll likely show up as a bigger refund, or maybe you'll owe less than you otherwise would have.
Okay, so patience is needed for that first year's benefit. Good to know. And just briefly, the policy context. How did we get here?
Well, these were apparently a compromise. The original ideas might have been broader, maybe uncapped. Some nonpartisan groups like the Tax Foundation have called them, political gimmicks that add complexity.
And being temporary.
Creates that fiscal cliff.
Yeah.
Congress will have to decide whether to extend them after 2028. So expect more debate down the road.
Okay, so what does this all mean as we wrap up, the bottom line for listeners?
I'd say the key takeaways are these are specific temporary benefits. They reduce federal income tax only, not FICA. They're capped, they phase out with income, and they mainly benefit middle-income hourly and tipped workers who are below those phase-out levels. And for 2025, remember, the benefit comes at tax time, not your regular paycheck.
Right, so thinking ahead, given these deductions are temporary and they're targeted in a specific way, here's something to mull over. What implications might this kind of approach have for future tax policy debates? And maybe more personally, how might this temporary change affect your own financial planning over the next few years?